here we are talking about having more and more smaller SKUs because if you have 5 kwacha, you should be able to find a product that you can buy. If you've got 10 kwacha, if you've got 15 kwacha, that's what we mean by small format. So if we have 100 grams, 190 grams, 330 grams, you will be able to at least find something that you can buy. We are also continuing to invest in what we call license to operate infrastructure. In order for us to be able to make safe food available to the market, we need to make sure that we've got food safe facilities, and we, as you will see when I take you through our investment program, we are investing in a big food safe state-of-the-art warehouse that will be located at our Nakampala factory, and I'll talk about that. We also, within that warehouse, will have a big packing facility that will enable Chembe to meet market demand in a more flexible on a more flexible basis, where you'll be able to decide which SKUs the markets need and so on, more responsive than we are currently. The second strategic objective is to maximize milling capacity utilization. I think I've shared with you before that we've got a factory that is capable of producing up to 445,000 tons of sugar. We've been producing at around 400. We think that in the next 3 to 5 years we will take it to 425, and then beyond that take it to 445,000 tons. And that's an opportunity that we have, because if you think about how much it costs to expand a sugar factory, if you have a capacity of 45,000 that you can just utilize, we have to exploit that opportunity, and we were looking at that. And then achieve power self-sufficiency, as I've said, is about meeting our own power needs when we are crushing cane, and then beyond that, we'll be looking at other opportunities like solar that can produce electricity all year round. So those are the 3 things that we will be working on. We believe that if we do these 3 things very, very well, and that's our intent, we will move the needle for Zambia Sugar. Why are we doing all this? I just thought I would share with you that we have a market that's driving everything that we are doing. So what we are showing in this graph is the total potential sales for Zambia Sugar. So if you look at the purple line, which is the supply, you will see that it's sitting at that 400,000 line that I spoke about, that we are currently producing 400,000 tons of sugar. So whereas the market itself exceeds that supply. So what we are doing at the moment is we produce 400,000 tons of sugar. We meet domestic demand, which is an obligation that we have to make sure that the market is fully supplied, and then whatever is left we export. So we are basically treating the export market as a residual market. So you just sell whatever is left. But we could be selling a lot more, as you can see. If you draw the line from 616,000 tons back, you can see the gap that we're not supplying. So if we can produce 445,000 tons of sugar, we'll be able to sell it into the regional market, and as the market grows, we'll continue to grow. So we have a growing domestic and regional market that we as Zambia Sugar can be the best at selling. So I think it should encourage all our shareholders and stakeholders that here is a business that has market opportunities, has a strategy, a well-defined strategy to pursue those opportunities, and has set their 3 strategic objectives that drive them towards exploiting the opportunities that we have. So just wrapping up on the business updates section of our presentation, I just thought I would share with you the strategic investments and initiatives that we have. We've now refined them and are able to quantify the investments that we expect to make. So, route to consumer. This is how sugar moves from our factory and ends up in the hands of the consumer. What are the assets that we need in order for us to be able to do that? So I spoke to you about the warehouse. So we produce the sugar from the factory, we put it into the warehouse, which is food safe. We then, from that warehouse, there will be a packing plant that's now packing to meet market demand, and then to produce those small packs that I was talking about, and other needs that might arise in the future. But we will then be equipped to be able to respond with the state-of-the-art route-to-consumer infrastructure that we are investing in. And also, it is mission critical in the sense that it enables our mission to make high quality and safe sugar. The estimated cost of this particular project is $55 million US dollars. We've done this in US dollars because of the fluctuations that happen with the local currency. And by the time that we finish our capital approval processes, it's better to actually do this in. So this project has already started. We are at the final stage of our capital approval process, and we expect that by August we'll go to the final stage, and then once we've passed that final stage, we'll then be in a position to engage with the bankers that are in the room, because I can see that there will be. So we haven't reached the financing plan stage yet, but we'll be close. I think by the end of the year, we should be already starting to look at that. I spoke about the need to increase our production to 445,000 tons. But also, if you recall, in the themes, I spoke about a robust, reliable, and resilient factory. In order for us to get to the level that we can have those 3 R's, reliability, resilience, we need to invest about $100 million in the factory, and this is something that will be happening in parallel to the warehouse. The one thing that I need to highlight is the fact that these projects are not sequential. So we are able to be working on factory optimization. We'll be working at route to consumer because they are not linear, they are not sequential. So like you have to do this one first and then do the other one second. You can actually be doing them in parallel, and that's what we are doing. So we've got teams that are working on factory asset optimization, and we've got teams that are working on the route to consumer assets project. Refined sugar, we have two. We've got two phases that we are looking at. The first phase is really to optimize our existing asset base. We've got a 90,000 ton refinery. We haven't produced the 90,000 yet. So the idea is to be able to do that first, and we'll be investing just from our own resources around 100 million kwacha to be able to do that, and that's immediate. We're already working on that. And then I spoke earlier about the opportunity that comes with industrialization and the 6 to 15% growth in the industrial sugar demand. And when we talk industrial sugar demand, we are talking mainly about refined sugar. So we have a 90,000 ton refinery. We see ourselves needing and doubling that. So So the last one costs about $90 million. So we expect this expansion to be $100 million. Again, we've got teams that are working together with consultants and others who are working on that particular project. This one is to some degree sequential because it has to be integrated with the factory asset optimization, because the sugar comes from the main factory to the refinery, and there are linkages that are there. But we're working on that. Electricity generation, here I'm now giving you the exact numbers that we are working on. In the short term, as in now, we're actually working to invest in an 18 megawatt generation unit at an estimated cost of $20 million. So that's something that's happening right now as we speak. We are busy putting together a team that's working on that project. And significant progress has been made. We are at the penultimate stage of our capital application process. The expansion of electricity generation that I was talking about in terms of it becoming an additional revenue stream, here we are looking at investing an additional 40 megawatts. We'll then need high pressure boilers and associated equipment at an estimated cost of $70 million. The commitment to make these investments from our group is there, and we are engaging with the government to make sure that they enable these investments. As I highlighted to you earlier, we are part of a big group, and the fact that our group is willing to make these investments is a big vote of confidence in the Zambian economy. And we have no doubt that particularly the electricity generation one, which requires an enabling environment, that the government enable us to make that 70 million investment. And then finally, there are other smaller projects that we'll be working on. This is to support community projects in the Masabuka area, and then to continue to monitor what's happening in the markets, and then exploring those additional products like ethanol that I spoke about. So hopefully I've given you some excitement about what Zambia Sugar is intending to do in the next 3 to 5 years. And as we continue to engage, we will be giving you progress on how we are doing. I'm hoping that when we gather again in October or November, I'll be able to tell you that the warehouse project has now been approved, and where we will be with the other projects. We're an exciting, energetic business, and I hope I've given you something to be excited about. Thank you for listening.
Thank you very much, Oswald. Certainly very exciting news. We're really excited. We're excited about the future of Zambia Sugar, and we assure you your money is in good hands. At this point, I'd now like to welcome Nyondwa, who will share with us the financial performance of the company over the past 6 months.
Morning, everyone. I'll just build on to the excitement that Oz has mentioned and just go straight into the business performance. In terms of the operations, we've seen an increase in cane supply compared to the prior 6 months to February 2022. We've got an increase in cane supply by over 18%. So this is mainly driven by the increase in both from the growers as well as the estate. We had improved climate conditions as well as irrigation, improved power supply for irrigation. This has resulted in an increase in production. So looking at the just ended season, we closed with cane supply of 3.3 million compared to 3.1 that we had in the previous season of March 2022. With this improvement in cane supply, we do have an improvement in production as well. So our production closed with 400,000 tons compared to the production just the previous season of 319. So these are the main drivers that we see in the financials that we have. So the increase in production has resulted in available sugar for sale in the domestic market as well as on the export market. Just briefly on the changes that we have on the profit after tax. So we're seeing an improvement in revenue and of 104. I will go deep into the revenue on the next slide. But what we're seeing there is we do have pressure on the domestic market. We did have pressure on the domestic market for the first 3 months, but we've seen an improvement, and this is mainly coming through from influx of illegal imports. But Chembe and his team are on the ground trying to manage that, and this is mainly through the promotions as well as the non-price tactics that they are moving on. I think also mentioned that we're bidding on our route to consumer strategies, and that's what is driving the improvement in revenue. In terms of the cost, the costs are under pressure, I think, with the fluctuations of the exchange rate and as well as the increase in price of our key production costs. I'll give you an example of the fertilizer, packaging materials, employee cost. Fertilizer prices have been fluctuating, I think, mostly attributable to the Ukraine war, the war going on, and we've had pressure coming through from that. But I think just driving on what Oswald mentioned, I think the business has embarked on cost management strategies, and that's where we've been able to manage our costs, and we have a total cost escalation of 11%. Could have been higher, but I think with the strategies that we have in the business, we are confident that we'll be able to maintain the cost escalation as the business moves. In terms of finance costs, there's a marginal increase there, mainly because of the increased utilization. So we focused on our off-crop maintenance, and this is mainly to improve on our plant reliability. So we had to go to the banks just to help us with financing on our facilities, but overall, we're doing well in that area. So we do have a tax change there, and mainly driven to by we had the prior year, we had quite a higher effective tax rate, driven by the change that we had in the last financial year. So that pushed the effective tax rate slightly higher. But currently, that has normalized, so our effective tax rate is around 17.9. Just on the side of the revenue, so we're seeing an improvement in revenue of 5%, and I'll talk to the bridges that we have, the various pillars that we have. So I think I mentioned that we did have a pressure on the market, on the domestic market, from the influx of illegal imports. But we've seen a recovery driven by the response that our commercial team is driving in the last 3 months. So the volumes have been going up, and we see that improving. We do have better price realization of the domestic market. So you see that has partially mitigated the downside that we have on the volumes. On the export market, we do have a strong demand on the export market, and we do have an increase in volume. So the increase in production and the slowdown in domestic market made sugar available for the export market, and that has increased our revenue coming through from there. We're also seeing an improved on the pricing on the export market. So our commercial team is driving, is looking at prioritizing the high margin markets on the export market with the available sugar that we have from the increased production. So that's resulting in an improvement in the export pricing there. Then in terms of the FX, we got a benefit of the weakening. I think from December to February, we did see the kwacha weakening, and that's a portion of the weakening of the kwacha against the USD. I think most of our export sales are in US dollar. So overall, that's what is driving our 5% growth in revenue. Just a key highlights on the changes in equity. We're seeing an increase in equity of 765. And I think I mentioned of the improvement in production. So we're actually seeing that coming through. It's sitting in our inventory at the moment. So what that shows to the business is we do have the sugar available for sale. So with the drive of taking the sugar down to all the consumers, the consumer brackets, we do have the sugar available, and we do have sugar available for the excess for export market as well. So as of February, the production increase resulted in our increase in inventory. My cash flow is not as another cash flow, but that shouldn't put you down. But so when you look at, I think the big one that we have there is in working capital. In terms of the operating profit cash flow, I think we've seen the improvement in operating profit and the growth. So just driving on what the strategies that Oswald mentioned, as well as the way we've been performing and the prospect for the business. So we still see the growth in operating cash flow there. Working capital is just the sugar that we have on the ground. So, and this is sugar that we will be selling. So I think that's, like I said, we do have the sugar available for sale. So that's why it's sitting there. And I think we have the big one there in terms of the dividends that we paid. So overall, as of February, we closed with the operating, we're in overdraft of 410.
It makes the bank safe.
Yes, it does. So I think I just wanted to show where we're looking. I think based on the environment that we're in, as well as the performance that we have. So in terms of production, so we're looking at an increase in production from the just ended season, and we're focusing cane supply of 3.37, and that will result in an increase in production. So overall, we're seeing an improvement in profit after tax of 3.1. We do have pressure coming through. I think this is the continued pressure in terms of the cost. And so the strategies is to manage the cost so that it doesn't eat into the margin. I think for the investors, I think that's what we're interested in. And just make sure that the business is growing without pushing, without affecting the profitability of the business as well. So on the domestic market, the last 3 months that we've seen, and we are confident that we'll be able to meet the volume and catch up on what we've lost in the previous months. And with Chamber and the team on the ground, we're confident that we'll be able to maintain our 1 billion profit mark, profit after tax mark, and maintain the business at there. Then this is just to highlight where we are in terms of the price, the share price, and we see 260. I think when you look at the last 3 years, our share price has grown. So that talks to the confidence that I think everyone has in our business. We're still sitting at 18. I think that with the growth that came into August 22. So this trend is still continuing. And in terms of the dividend, we've seen the growth in dividends from, they just ended financial year, I think FY22. We had a dividend payout of 299. I think just on that one, I'll hand over to Eugene.
Thank you very much, Nyondwa. Thank you very much for that very clear demonstration of how the company performed in detail. At this point, ladies and gentlemen, I'll be opening it up to question and answer. But I'd like to especially thank the people who are online. We've got people joining us from all over the world. We do appreciate the time difference, so for that we sincerely thank them. It might be challenging in some parts of the world, so we sincerely thank them for joining us. We also extend a special thank you to you for beating the traffic, navigating through the Lusaka traffic on this busy day to join us in person. So thank you to you as well. I'd like to open it up to questions based on what we have shared this morning, and then we'll look at the next steps. So anybody with questions? Yes, Emily?
So thank you. Thanks, Eugene, and thanks for those presentations. And also congratulations.
So I'll start with the question on our perception of the competition and the locally produced sugar. We, as I said in my opening remarks, we believe in a free market, and in terms of a free market, people will join, will enter and exit industries based on their own ability to compete. And on our perception is that we believe that as Zambia Sugar, we are a competitive business, and we will be able to compete fairly with our local competition. So we will continue to want to be the brand of choice and focus on giving customers whatever it is that they want at an affordable cost. And we believe that we should be able to compete. That's the reason why we talk about being sustainably low cost. Because when you are sustainably low cost, you'll be able to compete. One of the advantages that we have is that we're in a business which is driven by economies of scale. So you can imagine right now we are already a very profitable business, and if we were to increase our production from 400,000 to 445, and we've already met we're already paying for our fixed cost right now, I will be able to become even more competitive on a cost per ton basis. So our perception is that local competition will be what it is because Zambia is a free market economy. But we as Zambia Sugar, we believe that we'll be able to compete fairly with the local competition. What is not fair is when we have to compete with illegal imports. These are sugars that don't pay tax. These are sugars that don't pay VAT. That don't face the same costs that we face. So as long as we keep illegal sugars out, we will be able to compete with local competition on a fair basis. So that's our perception in terms of local production. There was a question on what we are doing to reduce fertilizer costs and our strategy on managing FX risk. Yeah, fertilizer costs are a challenge because we basically are price takers. Most of the sugar is most of the fertilizer is imported, and we are then exposed to the vagaries of whatever it is that is happening in the international markets. For example, the war in Ukraine. Russia and Ukraine supply around 40% of the world's agrochemicals and fertilizer in particular. So you can imagine the impact that the war has had on our costs. In the medium term, what we've done is that we have used the group buying power. So what we've done is we've amalgamated all our fertilizer requirements for all the 6 countries in which we operate, and we've then gone to the market and floated a group tender, which is significantly by just allowing the big fertilizer companies to compete for that big volume of fertilizer. We've then been able to have under the circumstances a very good deal that has helped us to be able to manage our fertilizer costs. In the medium to long term, I know that there are investments that are planned here in Zambia to build a significant fertilizer plant in the country. We are hoping that fertilizer will be produced at a competitive cost, but even if not, we will at least have the availability guaranteed, because it's one thing, cost is one thing, availability and reliability are equally important to make sure that you have access to the input. So that will be my comment on fertilizer costs. In terms of how we manage FX risk, we use, I think there are a lot of bankers in the room here and some economists. So we use what is called asset liability matching. So we don't engage in, well, if we had a big FX exposure on an export contract or something, then we might approach the banks to hedge. But generally, we use asset liability matching. What that means is we are a business that makes our own FX denominated revenue, and we then just make sure that our FX costs are matched to the revenue that we bring in US dollars. As a result, we are self-hedging. So we look at, as you can see, with our export revenue going up. So we then make sure that our commitment in terms of fertilizer imports, payment in terms of maintenance, costs that are denominated in FX are matched to the revenue that we bring. That way we self-hedge. So we don't have significant exposure beyond our ability to match our FX assets and the liabilities that we have. So that's how we think, and we always have the option of approaching the banks to hedge specific FX exposures that we might have if they are material enough to require that. So that's how we do it. In terms of whether we anticipate that there will be a refined sugar deficit, right now, Chembe and our SNOP team are telling me that we'll have enough sugar, refined sugar, to be able to meet market demand without having to import. Chembe, maybe you can confirm that for our audience. Some of them are cost reduction initiatives, particularly the power one. When we talk about power self-sufficiency, when we supply ourselves with power, we just supply ourselves at the cost of producing the power. So that will significantly reduce our costs. Our power bill at the moment is about 200 million kwacha, so it's a big cost for us. So we anticipate being able to contain the cost increase at the very least, and maybe reduce it slightly. But I think the most important thing about power is that when we have load shedding, our cane production can drop by like 400,000 tons just from load shedding, anything between 250 to 400,000 tons, and that is equivalent to anything between 25 and 45,000 tons of sugar. So whereas people focus more about when the reliability of power, everyone thinks about cost, but actually power is what sustains your revenue. You are able to then produce the volume that the market wants. I was at our head office last week, and we were going through our strategy. And when I got to the power self-sufficiency one, some members in the audience were like just treating it as a cost saving, saying, "Well, I think you need to focus on the two objectives, because we think power self-sufficiency is a nice to have." And when I explained to them what happens when we don't have power, they quickly actually said, "That's the thing you must do first." So power must always be seen not from a cost. So if you do get a cost reduction from it, it's a bonus. But the most important thing is the fact that you have power to safeguard the volume that generates your revenue. That's the most important thing. So that's why the power initiative, that is its contribution. The contribution is that we will have the confidence that we will have the power to sustain our revenue. Then when we add all the initiatives, if we produce additional sugar, if we are then able to capitalize on the flexibility that's going to come with us being able to pack according to market demand for Chamber and his team, we estimate that those initiatives that we've shared with you will increase our operating profit by approximately 500 million kwacha. So it's a very significant opportunity for us to go after. So our strategic plan, conservatively, obviously trying to, unless the bankers at the end of the day are going to tell us exactly what's going to happen with the kwacha, then we'll be able to give you a much better answer. So we've conservatively estimated that after implementing the strategy that we've shared with you, our operating profit should increase from the about 1.25, 1.3 billion kwacha where we are now to anything between 1.7 to 2 billion. So that's the contribution that we expect from those initiatives. From power, sustaining our revenue and making sure that we consistently meet the market, and then from all those other initiatives, additional sugar, the cost reduction that might arise from some of the initiatives will increase our operating profit by approximately 500 million kwacha. So that's then I think the other question, I think there was a question on margins. I didn't quite get that. I would.
Yeah, between your exports and your domestic.
Yes. So what tends to happen with the export market is it's difficult for you to be able to have a specific margin that you, as I said, you're a price taker, and often what happens is if the price in the export market is $650 per ton, the margin that I'm going to get simply depends on my own production cost, which is why when we talk about sustainably low cost, if you heard what I said that in the export market it's commodity play. So you are a price taker, and hence you need to be producing at the lowest cost possible. In the domestic market, you do get the brand effect, and you get a premium from the preference that consumers have for for our brand. So it's difficult to we actually don't calculate export margins separately. What we do is we calculate the overall operating margin of the combined export and domestic volume, simply because in the export market you will take the price that comes. But in terms of the split, we are right now at 70-30. So 70% of our sales are domestic, and 30% is from exports. But as we said, exports, we limit them. So there will be times like now. The sugar price on the world market has been above 25 US cents per pound, and the way the export price is determined is based on, it starts with what the world market price is, then you start adding your your logistics costs and all the other costs, and then you arrive at the price. So the higher the world market price is, the higher the export price is going to be. And depending on what is happening with the kwacha, if it has depreciated, we'll suddenly find that exports are better than domestic. But the question is, we don't have the capacity to just say, well, now we don't supply the domestic market, because remember that the domestic market is about feeding Zambians first, and then we export. So we have an obligation to supply the domestic market even when exports are doing better. I think you have seen recently what happens when people prefer to export maize, and then we suddenly run out of maize, and then we're not able to feed ourselves. It's the same thing. If we today, with the way the export market is, we could just go and sell. As I said, we are treating the market as residual, but the demand is there, but we limit the amount that we sell. We could decide to sell more of our sugar to the export market and make more money, but that would mean that there will be serious shortages of sugar in the domestic market. So that's how we play the. Yeah, I think those were the main questions. I was able to answer all of them because they were not that difficult.
Thank you very much. So Chembe did pose a question, where do we see the kwacha? That's a great question indeed. So clearly, when everyone else is crying for an appreciation of the kwacha, I believe everyone in this room would be looking at that differently, because objectively, where the kwacha is sitting, and if it goes higher, it makes all of us smile in this room. So I'll ask for more questions.
Congratulations, to you and the team on achieving a fantastic first half result. Mine is on bagasse as a byproduct, but more importantly as an input into your thermal power generation. At current levels, will you be able to meet the expected increase in terms of your thermal power capacity output, or would you need extra work on the primary agriculture side to increase that bagasse output? It's really just to understand whether your current bagasse levels will support your ambition around power.
Current, there's a lot spoken about revenue efficiency. So if you look at the revenue asset ratio, which is how efficient your asset is, I think the ratio is quite reasonable at the moment, almost 50%. However, going to the next 3 years, if you make all the investments you've outlined to make, totaling about $270 million, if I'm not wrong, what level of revenue growth do you anticipate within that period to make sure that you are still efficient as a business?
Environmental initiatives that we have. So I think most of us are aware of one of the main thrusts in 21st century businesses is ESG agenda, the environmental, social, and governance agenda, trying to address producing sugar without harming the environment. So when we talk about sustainably producing cane sustainably, sugar sustainably, we are looking at the E aspect of the ESG agenda. So we have quite a number of initiatives. One, I've already said that we've been producing cane and sugar for 50 years now from the Mazabuka areas. That shows you that our management of soils is sustainable because we've continued to be able to produce and the soils remain productive. So we have new farming systems. We've just launched a new farming system that is starting. We've employed a specialist to come and drive a new farming system that makes sure that we introduce organic matter back into the soil before we replant cane. As you know, you plant cane and then you harvest anything between 8 and 10 crops, and then you have to replant again. So before we replant again, we now have a system where we grow a cover crop called sun hemp, or in some cases, if your system allows, you can grow soybeans and other leguminous crops, because what they do is their organic matter is very good for the soil. So we have in agriculture what we call green practices that we are embarking on, which fall under the new farming system. So that's one initiative in terms of sustaining the productivity of the land, which sustains us. So that's one initiative. The second one is, if you look at the sugarcane growing process, one of our biggest impacts on the environment is the water that we abstract for irrigation. So the idea is to make sure that we use water sustainably, which means we don't abstract more than the systems are able to sustain. So what we have is a significant program to upgrade our irrigation systems. We will be investing in drip irrigation, which is the most efficient irrigation system that's available. We've already started phase 1 at Nakambala. We are already at phase 3 at our Nanga farms. Our target is to reduce our water consumption by 30%. By 2030. It seems like 2030 is creeping. When we were talking about this, it seemed like a long time into the future, but now we don't have that much time. So we have a target to reduce 30% of water consumption through investment in irrigation systems. We are also trialing an innovative furrow irrigation system. Now I'm getting very technical. So there is a system called SSID, or short furrow irrigation system. What it does is you continue to use furrow irrigation, because on our estate we have about 11,000 hectares of furrow, and the advantage of furrow irrigation is that it doesn't use electricity. So if we convert that to a pressurized system that uses electricity, we create a higher demand for electricity, which creates problems. So we are looking at continuing to have the advantage of furrow irrigation through this innovative system. So that's those are the environmental initiatives in agriculture. We also have several other initiatives, for example, in packaging, making sure that we move away from plastic, and we only use biodegradable packaging. That's one of the initiatives we have. We also in the factory are looking at the management of emissions. I spoke earlier about high pressure boilers, which will be cleaner than the ones that we have. That's another environmental initiative that we have, which will just be addressed by our investment program. So we are very active in the environmental management space. Someone spoke about climate change. Climate change, the prediction is there will be less water, there will be more droughts, and if we do the things that we are talking about, investing in short furrow irrigation and drip irrigation, we should be able to to withstand the changes that are coming with climate change. Less water will then be absorbing less water. So that's that in terms of. And by the way, you can come and visit us, and some of this technical jargon that I'm talking about will just be things that we just see, and it will become very, very clear. So you are welcome to visit Nakambala, and we'll be able to show you, take you into the field, see some of these technologies that we are testing and some of our environmental initiatives. It's quite a good use of time. Moving on, there was a question about bagasse and the capacity to meet our power plants. So there are two things. I spoke about the need to increase production from 400 to 445,000 tons of sugar. That comes with an increase in cane supply. So we first must increase the amount of sugarcane that is available. So if we bring an additional 400 to 500,000 tons of cane in order to make that additional sugar, that comes with bagasse. And because I want the interactions that we have with you to be opportunities for you to learn a little bit about sugarcane and so on. So every ton of sugarcane has 35% of bagasse. So 35% of 450,000 will be the tonnage that we'll get, the additional tonnage that we get of bagasse. So that will be the first source of bagasse. The second one is you can invest in technology that uses less bagasse to produce 1 megawatt of power. So the reason why we are talking about, so you have low pressure boilers, you've got medium pressure boilers, you've got high pressure boilers. So high pressure boilers use less bagasse. That's why when I spoke about the initiative to invest in that 40 megawatts of power, I said 40 megawatt unit, high pressure boilers because we are trying to produce within the bagasse that we have, the current bagasse that we produce, the additional bagasse that we are going to get from additional cane, and then trying to make sure that our power requirements are met in there. Domestic market growth, I'll ask Shembe to talk about that, where he sees the domestic market going. And then about the last question was on the assets revenue ratio that right now is in the range, but what will happen if we increase the investment based on the capital plan that I shared? I did say that we are expecting our operating profit to increase by 500 million kwacha. You can convert that operating million back to revenue based on the margin. So the additional revenue that we are going to get from the additional sugar, and then also the cost reduction that we expect from our initiatives, will actually just make sure that if we don't improve, we maintain the current ratios. There is a question that has come through online from the UK about dividends. I think because we have a dividend paying policy, which is 50% of free cash flow, and you arrive at free cash flow after you have deducted your capital expenditure. So I think the dividend that will be paid will be a decision that the board is going to make after taking into account the capital projects that we will submit. So it's not easy to say it in terms of a ratio, but it will be 50% of free cash flow after we take into account the investment. We still believe that we should be able to at least match what we paid the previous year. So that's the projection on dividends.
Team for the good half-year results. I'd like to ask a question around some of the expansion plans. I agree it makes sense that you want to add a packing plant and a new SKU in terms of the smaller units. Given the current economic conditions, that makes sense, and it's a way to ensure you continue to drive sales with higher prices, right, with a high inflation environment. I just want to get an understanding of the reasoning behind the planning in terms of the timing of when you'd like to kick in these projects, given that it actually might help drive domestic sales in the immediate term. Thank you.
My name is Joseph Komwa. I'm from FNB. Thank you, Oswald and Yondoa, for that beautiful presentation. I think it was very focused and concise. I think my question will go around one of the pillars that you have discussed, which is operational excellence. So I wanted to find out, from an operational excellence point of view, what benchmarking techniques has Zambia Sugar employed, and where does it stand within the Ilovo group? Thank you.
Thank you very much.
Thanks for those two questions. I think the first question talks to the timing of the investments. At some point, your timing is dictated by your capital process. So once you have triggered, like now we've said that we do need to have this route to consumer asset at Nakambala in the form of the warehouse and the associated packing plant. We've already made the decision. So what is now determining the timing is simply how long our own capital process takes. There's no more going back. And we believe that our target is to have the packing plant and the warehouse on stream by 2025, which is we estimating to construct this project in the next 24 plus months. So that's now the timing. It's all now down to how long it takes to finish the capital approval process and how much it takes to build. At some point, that's you reach a point of no return. Once you've triggered something, you just have to follow through. I think that's where we are now in terms of that. And also, I think what is very pleasing in our situation is that our market opportunities are robust. As I've already indicated, if we make more sugar today, we'll be able to sell it in the export market, which is very attractive. At the moment, we are limiting that market. So we've got opportunities that some would actually say, at the moment, you are leaving money on the table. So the timing, if everything was perfect, would be we do everything now because the opportunities are there and would actually shorten our time to value. So we'll get to value quicker if we could do all these things quickly. But as you know, we have to go through the different hoops and so on in order before you can spend shareholder money. So we believe that the timing is good, and we should actually do it sooner than later. So that's that one. Then the other question was on the pillar of operational excellence. So the pillar of operational excellence, you benchmark yourself against. So initially, because cane growing conditions are not the same. So in Zambia, we are the best performing in terms of yield, cane yield per hectare, which is the first measure of excellence. We get about, on average, combined growers and us, about 110 tons cane per hectare. You'll find that most other industries are between 100 and 105. And in South Africa, they are a lot less. You are talking like 70, 80 tons cane per hectare. So from a cane production perspective, we are operationally much better than all the others in our group at the moment. So Zambia Sugar is top. And in Southern Africa, if we compare ourselves to Zimbabwe, Swaziland, where I came from, we are still top in terms of that. But we don't want to sit on our laurels and just say because we are top, we don't continue to innovate. So that's compared to the group. We then also benchmark with some of the top industries in the world, Australian sugar industry, Brazilian sugar industries, and compared to those, we will be in the top 3, top 5 in the world. So we, as I said, we are very competitive. We have significant opportunity to improve in terms of cane to sugar ratio. That's the other. So there's the yield you get per hectare, which is, as I said, on average 110. Then there is how much sugar you make from a ton of cane. So our cane to sugar ratio is 8.1. So if we have 10 tons of cane, we make about 8.1 tons of sugar, which again is high up there. You can go on Google and you will see that we're high up there in terms of those operational efficiencies. But we are continuing to do more and pushing the envelope as far as we can. But at the moment, we are satisfied with where we are, but we are continuing to strive to get better. Hence, we have that pillar to keep pushing us and pushing the envelope all the time when it comes to new best practices and innovations. I think those were the last questions. Thank you.
Thank you very much, Oswald. It's almost 10, so I guess we'll be wrapping up unless we have any other questions. So there are no questions. Okay, maybe just very quickly touching on the ESG agenda that Oswald mentioned. Ilovo has put us in these project groups where they're looking to us bring up projects that support the business. And one area of project that we're looking at is water use consumption, working with the University of Pretoria. And what we've discovered is that there is no one size fits all. It's very interesting, actually. So there would be drip, there would be center pivot, there would also be this initiative that Oswald has mentioned, which is a short furrow irrigation system, which is really the way to go at Nakambala. So we'd really invite you to come to Nakambala, look at this innovative way of managing water that we have introduced with respect to sugarcane production. So we invite you all to come and look at the innovative measures that we're focusing on with respect to ESG. So at this point, I'd like to thank you most sincerely for joining us. We thank the people online, as well as the people who've come to share with us in person. I'd like to ask Oswald to just come and give his concluding remarks, and then we'll call it a day. Thank you.
Yeah, just for me is to thank you once again for coming and making this a very interactive sessions. We always value our interactions with all stakeholders, and the fact that you come to spend this valuable time with us is something that we appreciate very much. We've extended an invitation that when you've got time, please visit us at Nakambala. We'll be able to share with you some of the initiatives that we're doing, and you'll be able to see some of these things in practical terms. When you talk about short furrow irrigation, it's a very interesting innovation to just see how you can innovate on an old technology. Even I was very excited to see how much work has been done in the time that I've been away from engineering. So we invite you to come and visit us, and we look forward to interacting with you again towards the end of the year and to give you another update. And as I said, hopefully by that time we'll have more of the bankers smiling because we will then begin to talk to them about financing some of the capital projects that we